This market was desperate for consolidation. Is this the right deal, even though Postmates maybe wasn't a big competitor? I guess you just want to take out a competitor and consolidate in any way you can?
Sure. Hi, thanks for having me back on the show. I think the important thing to note here is that these two companies have competed against each other for better part of a decade. Postmates started out as a courier API, in fact, and wasn't food focused. Uber Eats came into the market well after Uber ride sharing did, and there were early acquisition talks actually about merging the two companies about 4 years ago. And I think at that time, Uber Eats was seeing hypergrowth as a new business subsidiary within Uber on the Uber platform. And so it just didn't come together at the time. But what Postmates has done well over the years is really build a strong brand with their customers and in the market. And so even though it's number 3 in the marketplace in terms of delivery service companies, they offer key advantages in certain key markets like Los Angeles and offer a market share gap closure for Uber Eats to get from number 2 to close to number 1. An important thing to note too is that Postmates has done a lot on the API side originally as a courier company. And so the Postmates API service is well used by a lot of companies across the nation as the last mile fulfillment for their consumer packaged goods and food. And so in this time of COVID, Postmates has done a great job of providing what's true to their service. And then with the combined merger with Uber, what we think will happen is that Postmates will stay independent as a brand, but they'll share resources and join the Uber marketplace platform, which should provide commingling all the service drivers as well as all the technology backend to improve a lot of the data analytics that both companies have been investing.
Steve, what does this mean for the industry and the consumers as you have Just Eat Takeaway with Grub, Uber with Postmates? Do prices go up?
I think Grubhub, with Grubhub, the thing to note is that that was a food delivery company, but it did not provide the actual delivery, the logistics. And so Postmates is actually number 3 in the market in terms of offering both a menu and a network of restaurants and order functionality, but also a network of delivery couriers. And so I think what's important to note here is that what it does is creates consolidation in a market which is highly competitive. People are fighting for drivers. People are fighting for the attention and exclusivity with restaurants. And I think that with consolidation, I think a lot of the marketing expenses and cost of acquisition should be improved across the system, not just with Uber and Postmates as a combined entity, but also for all the competitors. So I think it's an overall great thing for the food delivery service industry.
Steve, you're a big investor. What opportunities are you now seeing that have been disrupted and some fresh opportunities that are coming about due to the pandemic?
We're seeing, COVID has created compression across society and the economy. And in that compression, we've seen, a lot of concerning things, but then a lot of interesting notions and insights. So if I were to pick 3 areas where we're seeing a fair amount of new insight, it would be health and wellness. It would be in e-commerce and marketplace services, which we just discussed, and also in infrastructure software, in the future of how we're going to work as an economy, whether it's in offices or in factories. On the first point, the idea of health and wellness used to be going to the hospital and going to wait for a doctor and get an appointment and then get your prescription. And these days, at-home care through virtual care, telemedicine, has inverted the entire system. We were on a video conference with a health system, a CEO of a major health system in the United States, and they said that their 5% of their visits with patients were telemedicine pre-COVID. During COVID, it's been 95%. So it's completely inverted because of the pressure that it's created on these health systems. And so we have a company in our portfolio called Heartbeat Health, which is providing heart health, cardiology, as a virtual care service, connecting cardiologists around the country with their patients directly. And they've seen tremendous growth, recently announcing a partnership with American College of Cardiology. In the software space, we've seen a ton of pressure both on infrastructure as well as communication and collaboration software. You've seen that with Zoom, Slack, Microsoft Teams, and we continue to see a lot of startups in our space really seeing 5 to 10x demand for various software applications that will allow their teams to be distributed. The future of how we're going to work is going to change. One is we're pushing for a distributed workforce. It's forcing us to put everything in the cloud, and you're seeing that with the rise of companies like Five9 and AWS seeing maximum demand. We've actually been hearing that GCP, AWS, and even Azure are running out of capacity and scrambling to figure that out. And we've been hearing that from a lot of startups in our portfolio. And so I think there's some telling signs.
Yeah, I just wanted to follow up on that note quickly here. It's interesting. I was surprised by this. As you talk to some of your portfolio of companies and within your space, companies that have IPO'd recently are actually outperforming the S&P 500, indicating that it actually might be a good time to go public, as crazy as that sounds in the middle of a pandemic. Are you talking to companies about if now actually could be a good time to be going public versus staying private?
Yeah, I think that what's happening right now is that a lot of these technology companies provide a solution for our situation. Now, these were great solutions before COVID, but during COVID, what it's really done is sort of shone a light on what is a way to be able to operate as a company or as a business or as an industry, even as just an individual human being. And so a lot of these communication, collaboration, workflow companies, if they're seeing increased demand, going public right now, whether it's direct listing or IPO, makes a lot of sense. The capital needs to find great investments in this time of great volatility. And what we're seeing right now is not only increased demand. I mean, one of our companies is Tonal, which is a at-home connected fitness company. They've seen over 400 or 500% growth in demand year over year, just like Peloton has. And so if you look at the Peloton IPO from last year and you watch their performance through this year, you can see that spike in demand, and that's going from the individual side at home all the way to the company and corporation. And so I do think that it's strangely, paradoxically, a interesting time for a technology company that is a solution, that brings a solution to market that is much needed. It is an interesting time for them to go public.